Hello, my name is Ralph Burns, and this is a topic that was presented at the HFMA Region 8 Mid-America Summer Institute on Tuesday, August 6th, 2019. The perfect storm. Do you have what it takes to ensure a positive margin in an alternative payment model era? I currently serve as a Senior Business Data Analyst and Cost Accountant at Cooper University Hospital. I am a longtime HFMA member and the author of this presentation. Cooper University Hospital is located in Camden, New Jersey, just across the Delaware River from the city of Philadelphia. Cooper is an academic tertiary care hospital with over 600 licensed beds, a Level 1 trauma center, a medical school, and a cancer hospital in partnership with MD Anderson. To serve, to heal, to educate. For what will it profit a man if he gains the whole world and loses his own soul? The concept of profitability has been around a very long time. It is a fundamental concept with a simple formula. Revenue less expenses equals profit. In the healthcare industry, back in the 80s, DRGs were introduced as part of the prospective payment system, a method for determining revenue. And around the same time, there was a focus on cost containment, an initiative to measure and manage cost. In Pennsylvania, they formed an organization called HC4, the Healthcare Cost Containment Council, with a combined primary focus on profitability. Fast forward today, 2019, and APM, the alternative payment models, focused on revenue, along with a revitalized awareness of cost accounting practices in healthcare, again with a primary focus on profitability. The point of all this? Nothing new, basic, simple, fundamental. And when it all comes together, you have the perfect storm. Accounting basics, the profitability formula that we just looked at, the matching principle, revenues to expenses, and cost definitions. All basic, all simple, with a twofold challenge. The implementation and maintenance of the basics. First, to ensure that they are properly applied at varying levels of detail, granularity. Second, to maintain the integrity of the basics as the organization evolves and changes. Before we continue, let's take a moment to understand the primary difference between healthcare and most other industries in terms of profitability. Most industries start with cost. They will calculate the cost, decide on a profit margin, set pricing based on what the market will bear, and if it's not profitable, they can choose not to proceed. In healthcare, there is an initial decision to care for people, and then finding revenue to support the process of providing care, with a major difference being that healthcare revenue is dictated and negotiated. Lastly, cost is calculated to complete the profitability formula. Let's take a closer look at the alternative payment model, the revenue side of the equation. There are four basic categories. The first category is relatively simple, fee-for-service with no link to quality. The second category is fee-for-service with a link to quality, increased complexity and risk. The third and fourth categories are progressively more complex, primarily due to the amount of data that is being collected and measured to determine revenue. Each level presents additional complexity and an increased risk of reduced revenue. There is something interesting about the APM concept. One of its purposes is to reduce healthcare costs. However, there is an inherent increase of cost to the service provider relative to managing APMs. There are departments and activities that were not historically necessary. For example, specific functions of quality care, population health, and contract management. An analysis of one hospital showed that almost 4% of their overhead costs were related to these services. Some hospitals could be as high as 10 or 15%, depending on the amount of resources they commit to the process. This demonstrates the importance of costing relative to measuring and managing. Do you know what it's costing your organization? Let's shift our focus to the costing side of the equation. This cost adoption model was introduced earlier this year. It is made up of 25 components that are grouped into categories or levels. It is designed to be implemented from the bottom up, starting with a simple costing methodology, ratio of cost to charge, RCCs, followed by an introduction to more detailed costing methods, such as relative value units, RVUs. And as you approach the third level, the components begin to shift from costing methodologies to cost assignment processes. This is a useful model that serves as a basic guide to achieving objectives related to building a profitability reporting environment. But to successfully accomplish this, you first need a foundation to build on. Here we see a basic example of the costing and profitability reporting process, the foundation required for the implementation of any cost adoption model. It begins with financial data from the general ledger, then the reclassification process to convert financial reporting definitions to cost accounting definitions, a construct that reflects operational activity, followed by steps that include the implementation of billing system data, cost calculations, allocations, and assignments, with a profitability reporting structure as the end result. It is in the details of each of these steps where the rules and definitions of a cost adoption model are implemented. Here we see a sample list of items that are generated from the process: profitability reporting, resource utilization, and so on. To demonstrate the need and value of this information, the chart at the bottom defines a financially fragile payer mix scenario. Please note, the percentages do not represent profitability. They represent the relationships between revenue and cost. Medicare, Medicaid, and charity care show an unfavorable relationship. All other payers are favorable. In an APM environment, the risk of reduced revenues could be financially detrimental to an organization with this particular payer mix. It also demonstrates the value and dependency on accurate costing and profitability reporting. This information is essential for managing and maintaining positive margins. It's a must-have for executive leadership. One of the items from the previous slide was the profitability report. Here we see an applied cost analysis method. It is the margin of safety calculation. It is based on break-even analysis and the effect of changes in revenue. The example shows the importance of cost structure balance. Hospital A has low fixed and B has high fixed. If revenue increases, it's favorable for Hospital B. However, if revenue decreases, a risk associated with APM, it is an unfavorable effect. Hospital A, on the other hand, with lower fixed costs, is strategically positioned to survive revenue reductions. Hospital A has what it takes. Cost structure balance accuracy is based on proper fixed and variable cost definition assignments. So let's take a closer look at those definitions. Cost behavior patterns relate to fixed and variable. Assignment to cost objects relates to direct and indirect. When a costing process is first established, it is a tedious task to implement, but the rules are relatively simple. The challenge comes with the magnitude. For example, cost definitions with almost 4,000 costing elements, which are defined by concatenating department codes and general ledger account codes, that are parsed into 15 unique cost components. The result is about 60,000 cost component detail records. Cost calculation results with over 16,000 cost objects. These are unique charge master codes. that will yield about 245,000 unique component detail items, and the cost assignment to encounters of over 380,000 per year, will have over 5.8 million unique items. You can easily see the magnitude of maintaining these simple definitions. A 2016 Healthcare Information Management Systems Society survey, HIMSS, shows that less than 40% of hospitals with cost accounting systems actually keep their systems current. A monthly general review during data loads and calculations, annual department RVU auditing, and cost model updates are a best practice recommendation. Simple definitions that require a special set of skills and a time commitment to properly maintain. Here are results of a 2017 survey conducted by the Institute of Management Accountants, IMA, of cost accounting professionals and the challenges they experience in the course of performing their work. Please take a moment to review this list and select your favorite challenge. The survey highlights the divide between financial accounting and management accounting. To address these challenges, we need to first understand the difference between the two perspectives, financial accounting versus management accounting. Here, we see the difference between the two disciplines. The common processes are shown in the middle, and on either side are the perspectives, focus, and purpose of the two unique roles. Within the role of the certified management accountant, there's a category that focuses on cost accounting. This is similar to the relationship of the certified public accountant and the category of tax accounting. Understanding these differences is important when making decisions that relate to costing and profitability reporting. Now let's look at how to implement all of this by answering the question, how to build and maintain a cost accounting system to deliver profitability reporting. Following Oscar Wilde's quote that life imitates art, here are 3 movie references associated with the basic elements of success: planning, skills, and a process. When it comes to having a plan come together, you need the A-team. 4 points I would like to share here are the Project Management Institute, an excellent source for education and guidance related to project management. The importance of clearly defined objectives, embracing the iterative process, and limited dependency on vendors and technology. Vendors and technology are excellent sources for the tools you may need, but be careful about how they might influence your decision-making process. Skills. In reference to the quote from the movie Taken, a very particular set of skills. The first 2 points of this item relate to revenue, and the second 2 points relate to cost. And finally, the process. From the Shawshank Redemption. What does it take to make a diamond? Time and pressure. 2 key components of any project. Set reasonable expectations, be clear about management's responsibilities, and an understanding of the difference between authority and responsibility as they apply to delegation. Now you think you know everything you need to know for a successful project. Don't be overconfident. Here are some statistics related to project failures. I find it interesting that only 31% of project plan definitions for success include meeting budget, and that budget overruns are a predominant point of failure. To emphasize risk to an organization related to projects, 17% of IT projects fail so badly that they can threaten the existence of a company. This information is not intended to discourage. It is simply a reality check, a call to awareness that needs to be part of your thinking when developing your project plan. Now let's pull it all together, a big picture view of the architecture. By its very nature, cost accounting is an agile process because it needs to constantly adapt to changes that occur in operations. There are three main sources of data for the process: operational data, commonly attained from a billing system in healthcare provider environments; financial data, revenue and expenses; and the revenue and costing modeling, the definitions and rules, where we find ad hoc data, such as FTEs, square footage, pounds of laundry, etc. The middle section is where the engineering and expertise are applied: reclassification of expenses, calculating cost rates, cost allocation to charge codes, cost assignment to encounter records, matching cost to revenue, and the management of several data definitions. This middle section is the curtain that the Wizard of Oz works behind, and you do need to pay attention to the man behind the curtain. And the end result, on the right, executive intelligence for planning and decision support, represented here in the form of a dashboard. All right, now let's wrap it up with a summary of items for the answer to the question, do you have what it takes? It's broken into two categories here. The first one, knowledge and understanding, specific to this presentation. The second category, corporate culture, which is important for supporting effective, efficient, and profitable business environments. And at the core of the second category are the people, the most valuable of all assets. Here are some references to resources that were used to gather information for building this presentation, and a special thanks to one of my colleagues, Chris Daniels, who assisted with the design and development. I appreciate the time that you have spent reviewing this presentation and hope that it has provided some value and insights. Give more than you take, leave more than you found. Thank you.